Hi, and thank you for joining me today. I'd like to frame my conversation with a reference to a movie called The Matrix, which was filmed in Sydney in the year 1999, rather aptly. And many of you will recall that The Matrix is a film about humans and versus computers. And it was a dystopian future of the world where AI had taken over the world and humans were effectively nothing more than batteries plugged into a machine to feed the power of the AI machine. And the AI created a program called the Matrix, which fooled humans into thinking they're actually living real lives. And we think that what we're seeing today in the market is very much an apt parallel with that. And so many of you will recall a scene from the Matrix that looked a bit like this. Ones and zeros dropping from the sky. But if you look carefully at actually what the Matrix is whispering to investors today, you'll see things like this. Specialty pharmaceuticals, neuromorphic chips, cloud call recording, a whole bunch of buzzwords that don't necessarily translate into fundamental earnings and cash flows. So today I'd like to offer investors a choice between blue pill thinking and red pill thinking. And to quote Morpheus from the movie The Matrix, after this, there is no turning back. You take the blue pill, the story ends. You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes. So why is the market like the Matrix today, and why do we see the parallels? In short, it's because we see a lot of things like the rise of machines, unthinking investing, quantum passive have been on a massive rise in the market in Australia and globally. And frankly, there's a lot of unthinking behind that. They're just simply buying stocks based on their relative market weights without doing any work on fundamentals. More broadly, there is this undisputed belief in what I call IZERP, or infinite zero interest rate policy. There's a complete and indefatigable belief that central bankers will always win. They'll keep buying bonds back and ultimately crush long-term interest rates to very low rates. So it's what we call the unthinking adoption of the status quo. And inflation is deemed transitory. In addition to that scenario, you've got retail rebels led by people following Reddit and other websites, jumping on superhero and Robinhood and gaming the system, trying to smoke out shorts in the marketplace. Lots of non-fundamental things driving share prices, and they're sort of playing the game. But ultimately, we think those investors are effectively gaming themselves. In short, the Matrix is everywhere. So we'd like to offer you a frame to think about investing, and I'm going to call it blue pill thinking. And what is blue pill thinking? It's really the slavish adoption that people have today of buying disruptor stocks or new economy, things with big buzzwords. Some of those names I gave you earlier in the presentation that sound hot and sound like they're attractive areas. And of course, the world is going through many transitions right now. New electric systems are coming through. We're going through AI revolution at the same time over the next 10 years or so. So lots of things to be excited about. But I guess this talk is here to show you that just jumping onto those trends without doing the work and doing business research and analysis will ultimately not lead to high returns. So there's very little application in blue pill thinking of long-term business economics, of industry analysis. There's a very high retail participation in the market right now, which is causing lots of irrationality and volatility in share prices. Fundamentals aren't even secondary. They are deemed irrelevant. Our view is that successful growing companies eventually make money and have business models that are durable and sustainable through market cycles. We are working in a probability game, not an improbability game. So guys, it's time to unplug and focus on what matters. And so I'd like to offer the other paradigm investing, which is red pill thinking. And that is where we focus on things like cash flow, business analysis, and valuation, all the fundamentals that we think drive long-term returns for investors and also reduce investor risk critically. In a strange way, though, short-term cash flow is not necessarily the best predictor of short-term performance. However, I'll show in this presentation later on that long-term, it is one of the key drivers of long-term alpha. The lure of the Matrix in the short term is very tempting for investors, and people buy what the Matrix feeds them. What are the crazy names? What are the exciting places to be involved in? And so, for example, over the past 12 months, in the top 10 performers of both microcaps and the small cap universe, you've had a lot of stocks that lose money and don't appear to have any cash flow. So in microcap land, only one of the top 10 stocks made money in the last 12 months. In small caps, only 3 of the top 10 actually made money. Let's go and dig a little deeper into see how these returns panned out over time. On this chart here, you'll see that over time, the market does what I call taking the red pill. In other words, it starts to reflect fundamentals better. So this chart on the right-hand side here is showing you going back 2 years, because obviously we need to give the market time to kind of reflect fundamentals. But going back 2 years, the top 10 names in microcaps were those stocks on the left-hand side there: Avita, Bellevue, Zip, etc. And you see that within that cohort, only one of those 10 made money, a bit like the FY21 year. And the returns in the FY19 year were incredibly stellar. The average return from those top 10 stocks was 202%. You can see in the bottom there of that table, versus the microcap index, which fell 2.2. In FY20, those stocks did okay as well. They rose on average 13% versus the market down 1.4. But in 21, so 2 years after they were the top 10 stocks, the average return was minus 11.2%. And they got absolutely destroyed by the market. So over time, gravity weighs, and loss-making stocks don't perform very well. Let's go back and look at previous cohorts and see how they formed, how they prepared. So microcap returns in FY18. This is going back 1 year again. Again, you can see the same kind of stocks bubble to the top. Concept-y stocks, loss-making names. Only 2 of those 10 made money. And you can see in the FY18 year, they had incredibly strong returns. But fast forward to the next subsequent 3 years. So the average return from fiscal year 18 to fiscal year 21 was minus 55% for that group of stocks. If you take out the 2 stocks that made money and just focus on the 8 stocks that lost money, the average return of that cohort was minus 66% versus this microcap index, which rose almost 60%. So a dramatic underperformance. So I guess what I'm saying here is that over time, the weighing machine of the market sifts through, and red pill thinking does actually dominate short-term blue pill thinking. If we go back again and look at further years, so FY14, FY15, FY16, FY17, so back 6-7 years now, and see how these stocks performed over time, the story is exactly the same. So at the top of this slide here, you can see that the average return for those FY14 winners over the subsequent 7 years was minus 73.4%. Sorry, but this is taking out all the winnings, this is just looking at the loss-making stocks and taking out any stocks that made earnings over that period of time. So if you're a loss-making stock in that top 10 year, we roll forward that performance and see how you performed. Minus 73% versus the market, up 136. FY15, minus 7.5 versus up 143. You get the idea. The market does sift through, and unless you make returns and cash flow over time, it will find you out and the stocks will come under massive pressure. One of my favorite examples going back in time was the FY 2014, or the calendar year, sorry, the fiscal year 2014 cohort, where you can see there the top 10 names all listed there: Liquid, LNG, Mint Payments, Impellus. And you can see what happened to those companies over time. 5 were delisted: LNG delisted, Mint Payments delisted, etc. They weren't delisted because they're taken over; they're delisted because they went bust. The one stock was profitable, Saracen. It made money in that year and subsequently got bought out for a big premium. But absent that stock, the rest of the cohort was pretty much a wipeout. So let's flip the script a little bit and say, okay, well, loss-making stocks over time don't perform. Let's go back and look at the stocks that were the best performing microcaps and see how they performed and what drove that alpha of those particular stocks. So we flip the script and say, back in 10 years ago, what stocks subsequently performed the best over that 10-year period? Not over 1 year or 2 years, but over 10 years. What gave you the best returns? And the list of those stocks is here. And you can see the names on the left-hand side: Altium, Pro Medicus, Objective Corp, Dicker Data, some names that you may be familiar with. And the returns are on the second column there. So Altium gave you a staggering 89% compound return over the next 10 years, Pro Medicus 83%, Objective Corp 63%. So stellar returns for a long period of time. To the right of those returns and those stock names, I just summarize the net profit. So just simply looking at net profit and how that transpired over time for all those stocks that were the best performing stocks over 10 years. And you see there, the darker the green, the bigger the number. So effectively, most of those names earned more money and more cash flow over time, and that got reflected in the share price and thus the long-term returns. The one exception here, of course, was Pilbara Minerals, which is a mining stock and was building up its own resource base at the time in lithium. But the other 9 stocks, all profitable and all grew earnings and cash flows over time, which led to their dramatic performance. Now let's look through that lens again one more time. Again, I call this compound red pill thinking. And what this is a 20-year chart in the small cap space. It's a Bloomberg back test, just looking at stocks that made cash flow and comparing those to stocks that didn't make cash flow. So conveniently, I've got the ones that made cash flow in the red there. So basically, it's a portfolio that rebalanced every single month and just bought with businesses with operating cash flow and tracked how that cohort of stocks sort of performed over time, getting rebalanced every single month. You can see that over a 20-year period, you get the red line, an incredibly large compound outperformance versus the index, which is the dark line in the middle there, and versus the blue pill line, if you like, which is the loss-making companies. So if you only bought loss-making concept stocks over that period of time and rebalanced to only stay in those names, clearly over a long period of time, you end up losing a lot of money and dramatically underperformed the index. Now, how does that all tie into current thinking? I guess the other way of thinking about this is that, I flagged earlier on that we do think that the market has this fixation with IZERP, or very low interest rates. We've seen central banks stimulate with incredible amounts of liquidity around the world. World economies are picking up, in response to that incredible liquidity. And so we're seeing inflation everywhere. Freight rates are doubling. Base material prices are up materially. And central bankers want us to believe that all this inflation is transitory. You can pick your own adventure on this one. However, it is shuttering its way through the supply chain, and you're seeing a very uneven impact on stocks. So some stocks can pass it on, others will get absorbed, will have to absorb the inflation and really struggle. The second order impact could be significantly greater, and that is that you could see the rates rise long term. And if you are in stocks, the concept stocks that don't produce cash flow and have no earnings basis at all, you'll see those stocks materially struggle. So let's give you an example of a stock that we think is Red Pill, and we own in our portfolios. And we think it's a really sound idea based on long-term thinking. A stock called Universal Store, it IPO'd in late 2020. And you can see our typical chart there on the left shows the cash flow conversion of this company is very, very strong. So over the last 4 or 5 years, it's converted almost all the cash flow to earnings, all its earnings to cash flow, and vice versa. So it ticks our boxes as a fundamentally good business with sound business mode. We like it. It's an on-trend, omni-channel apparel retailer for millennials and Gen Z consumers. Another reason we like the stock is because it's incredibly mature. It only has around 66 stores currently, and their target is to roll out well over 100 in Australia. It has no stores currently in New Zealand. So that gives you 4 or 5 years runway of double-digit space growth. Not only that, they make real-time use of data to feedback their stock purchasing. Many retailers buy in advance their stock for a full 9 months, 12 months in advance. You get caught with out-of-fashion stock at the end of the year and have to discount at big prices and really hit the margins. Universal Stores has this technology where they basically reorder multiple times in season, buying what's popular and selling to consumers what they're demanding, rather than what the buyers think they actually want to get. And they're pushing a private label. And finally, the history of the business is showing incredible, outstanding like-for-like sales growth. Get all that for about 10 times EBIT, 10 or 11 times EBIT, looking 1 year forward, which we think represents outstanding value, on top of the fact that it's fundamentally a cracking business. So in conclusion, what colour pill will you be taking? The red pill or the blue pill? Do you want to stay plugged in or follow a more proven investment model, which we think is red pill thinking? Over time, I've demonstrated to you the market does sift through hot and concept stocks, which may have incredible sounding business models or incredible sounding names, do incredible things, but unless they're followed up with real cash flows and real earnings, those businesses will struggle over time. We do think that central banks right now, which are stimulating incredible amounts of investment by companies and incredible recovery in economies worldwide, is generating inflation, and that is pretty much incompatible with long-term interest rates being zero. So in conclusion, blue pill investors may experience short-term alpha bursts when they jump onto these concept and exciting names, but longer term, we believe red pill thinking will see better returns through the cycle. Thanks for joining me.